On June 12th, SpaceX pulled off the biggest stock market debut in history. It raised $75 billion. The stock soared 67%. At its peak, the company was worth $2.6 trillion. And then, in just 3 days, $600 billion vanished. Gone. That's more than the entire value of most companies on Earth, wiped out in less than a week. So what actually happened? How does the most hyped stock in history lose $600 billion almost overnight? And more importantly, what does it teach you about how markets really work? Let's break it down. First, let's set the scene because the rise was just as wild as the fall. On June 12th, SpaceX went public on the Nasdaq. It was the largest initial public offering ever recorded, raising $75 billion. Investors went into a frenzy. Everyone wanted a piece of Elon Musk's rocket company. The stock priced at $135 a share, and within days it had rocketed up to around $225. That's a 67% gain in less than a week. On paper, SpaceX was now worth more than almost every company on the planet. It looked unstoppable. And then came the announcement that changed everything. At the height of the hype, SpaceX revealed it was buying an artificial intelligence startup called Cursor, an AI coding company, for $60 billion. Now on the surface, that sounds like an exciting, forward-looking move, a rocket company buying into AI. But the market's reaction was brutal. The stock didn't go up. It collapsed. 3 straight days of selling dragged it from around $225 all the way back down to about $155. So why did investors hate a deal that sounded so futuristic? There are 3 big reasons, and each one is a lesson in itself. Reason number 1, dilution. Here's the key detail. SpaceX wasn't paying for Cursor with cash. It was paying with its own stock. And when a company creates new shares to buy something, every existing share becomes worth a little bit less. Think of it like a pizza. If you suddenly cut the same pizza into more slices, each slice is smaller. Investors who already own the stock just watched their slice shrink, and they didn't like it. Reason number 2, fear about money. Right after this massive deal, reports came out that SpaceX was planning to raise another $20 billion by issuing debt, basically borrowing money. Now wait a second. The company had just raised $75 billion in its IPO, so why does it suddenly need to borrow $20 billion more? To investors, that's a red flag. It suggests the company is burning through cash incredibly fast. And analysts at firms like Goldman Sachs estimate SpaceX could spend over $1 trillion building out its ambitions in the coming years. That's a staggering amount of money going out the door. Reason number 3, it wasn't just SpaceX. While all this was happening, the entire technology sector was having a bad week. Big names like Alphabet, Amazon, and Microsoft were all falling too. When the whole tech market gets nervous, even the hottest stock gets dragged down with it. SpaceX just happened to be the most extreme example. So here's where it gets really interesting. Even now, the experts can't agree on what SpaceX is actually worth, and this is the part that matters most for you. One analyst at Oppenheimer thinks the stock is going to $250. He loves the Cursor deal. But an analyst at Morningstar looked at the exact same company and said it should be worth around $62. 62. That's less than half of where it's trading right now. Same company, same information, 2 completely opposite conclusions. And that tells you something crucial. When a stock is driven by hype instead of profits, nobody really knows what it's worth. It's not based on solid ground, it's based on a story, and stories can change overnight. So what's the real takeaway here? 3 things. First, hype is not value. A stock soaring 67% in a week isn't proof a company is great. It's often just proof that people are excited and excitement fades. Second, watch how companies spend. A business raising money and then immediately borrowing more is a sign to slow down and ask questions. And third, be very careful chasing brand new IPOs. The earliest days of a stock are the most volatile, the most emotional, and the most dangerous for regular investors. The people who bought SpaceX at the very top are now sitting on heavy losses just days later. SpaceX may turn out to be a great company in the long run. Rockets, satellites, AI. The ambition is real. But this week was a powerful reminder that even the most exciting story in the market can lose $600 billion in the blink of an eye. The smart move isn't to chase the hype, it's to understand what's actually underneath it. If this helped you make sense of the chaos, subscribe. I break down the biggest money stories of the week in plain English, no jargon, no hype.